Fixed annuities are important. I think they're exciting to talk about now that interest rates are starting to rise. You're starting to see much more meaningful rates on fixed annuities. That being said, let's dive right in. So what is a fixed annuity? A fixed annuity is a product with an insurance company that is designed to do a couple of things. It's designed to put your money in a place where it's going to protect your principal for a certain term. This is going to be able to give you some principal protection for those years. And they're going to give you a rate that is contractually guaranteed for that term. They won't have fees to be able to be assessed every year. They will have surrender charges. A lot of people think of annuities in comparison with bank CDs. Bank CDs have FDIC protection, and fixed annuities do not have that. CDs at the bank give you a fixed rate for a period of time. Sometimes fixed annuities pay a higher rate. CDs generally don't have as high of penalties to cash in if you change your mind during the term. Fixed annuities have what I would argue is much higher surrender charges during that term. CDs, you get a 1099 for the taxable portion of the interest you earn every year. Fixed annuities grow tax deferred. Both offer a fixed rate and a fixed term, so it's easy for people who are familiar with CDs to think about fixed annuities because they have similar characteristics in the sense that you get to choose your term, you get to choose your fixed rate you want to earn. Cool strategy that you can do with fixed annuities is a fixed annuity ladder. You have a ladder of interest rates and a ladder of terms that are coming due to create liquidity. Let's say that you break them up into even proportions. Let's say you have $100,000 and you put $20,000 in each fixed annuity, $20,000 in the 1 year, $20,000 in the 2 year, the 3 year, 4 year, and 5 year. After the first year, what happens? Well, the 1 year comes due. And so you get 20% of your liquidity available to you. You can use that liquidity if you need to put it back into the bank to be able to keep it liquid in case you need it. Or you could take that 1 year fixed annuity that's now matured, you could buy another 5 year. And what does that do? That keeps your ladder going because the next year, at the end of year 2, what happens? Well, now your 2 years matured. Now what was your 3 year is 1 year away from maturing. What was your 4 years a year earlier maturing? And that 5 year you purchased with the 1 year is now moving with you. And now you have that other additional 20% that's liquid. What do? Do you take it and pull it out of the ladder, or do you put it in another 5 year? And you can keep that ladder going. Every single year you're getting 20% of your annuity portfolio to become liquid for you. And you're getting a higher interest rate because you're buying a new longer term on your ladder. And if interest rates are rising, that's one way that you can accomplish getting those rising rates on a portion, 20% of your annuity portfolio. So a fixed annuity could be a good alternative for money that you want to have set aside for a specific time frame and you just want to get a better interest rate than you can find somewhere else. Annuities that are fixed can also play a key role in helping to create potentially a higher retirement income. Let's say you have a bucket of money and let's just say, for example, it's $200,000. Let's say you take that money and you split it in half and you take $100,000 of it and you put it into a fixed annuity ladder. 20% of that would be coming due every year, aka $20,000 would be coming due to you every single year for you to use. Let's say you take the other portion of that $200,000, $100,000, and you put it into a deferred annuity that's growing to accumulate a benefit base specifically for you to take a retirement income at the end of 5 years. You can have that annuity ladder provide liquidity for the first 5 years for you to take for your income, allowing that deferred annuity 5 more years to accumulate to be able to provide additional retirement income. In that example of taking $20,000 a year, maybe you don't use the whole $20,000, maybe your income need was $10,000. So with a portion of that, you can keep rolling it into more annuities to buy that deferred annuity more time to get that to be able to provide $10,000. Now, a lot of people would say,
well, you might be able to just find an annuity right then that could pay out 5% of $200,000 and provide you a lifetime income the entire time.
Depending on your age, depending on the types of annuities you're purchasing, depending on the interest rates, and depending on the roll-ups you can find on deferred annuities or the specific what's called DIAs, deferred income annuities you can find, you might be able to structure it a more efficient way to maybe beat that $10,000 a year that you could get. That would be one way you might be able to increase retirement income just using annuities, and having fixed annuities play a crucial role in that deferral to give you a longer time horizon so that a portion of your money can roll up or defer for longer to give you that potential higher income. So, I'm excited for the time when fixed annuities reach 5 and 6% again, and that would be a great place for people who for the last 10, 15 years have said,
where's a good fixed interest rate?
Now fixed annuities could provide that with no fee, and they could even provide that with principal protection for specific terms. So if you have more questions, feel free to leave them in the comments. Think about subscribing. I put out content weekly on how you can maximize fulfillment and live out your purpose in retirement. So thanks again for joining me in this video. I'll see you in the next one.